Retirement is a significant milestone, marking the time to enjoy the fruits of your labor after years of dedication. However, to preserve the wealth and financial security you've built, wise money management is crucial, especially as you enter this phase. Even legendary investor Warren Buffett consistently emphasizes the importance of protecting your assets. This video, drawing on personal finance principles and timeless wisdom, will unpack common mistakes that can deplete your hard-earned savings, guiding you towards a truly prosperous and joyful retirement, even amidst the anticipated volatility of 2025. Warren Buffett, the legendary investor, consistently offers valuable lessons on wealth building. As you prepare for retirement, smart financial management is key. It's about more than just hoarding cash. The goal is a truly prosperous and secure later life, especially with the economic uncertainties anticipated for 2025. While Buffett hasn't issued a specific list of warnings for retirees, his personal finance principles can help us decipher risks and protect our accumulated savings. Warren Buffett, the legendary investor, consistently offers valuable lessons on wealth building. As you prepare for retirement, smart financial management is key. It's about more than just hoarding cash. The goal is a truly prosperous and secure later life, especially with the economic uncertainties anticipated for 2025. While Buffett hasn't issued a specific list of warnings for retirees, his personal finance principles can help us decipher risks and protect our accumulated savings.
Mistake 1. Underestimating the silent enemy, inflation eroding purchasing power. One of the biggest yet often most underestimated threats to your financial security as you enter retirement is inflation. Picture inflation as a silent enemy. Not loud, not sudden, but silently and persistently eroding the value of the money you've worked hard to accumulate over your working years. This is an undeniable reality, especially as we look to the future, such as 2025 and beyond, where macroeconomic factors can continue to create unpredictable price volatility. So, how specifically does inflation impact your retirement plan? Very simply, it reduces the purchasing power of your money. $100 today might buy a full basket of groceries, but in 10 or 20 years, that same $100 might only buy half or even a third of that basket. Imagine planning to retire with a certain amount of cash, expecting it to last for 25 comfortable years. However, if average annual inflation is 3%, a fairly common historical figure in the U.S. economy, then after about 24 years, the purchasing power of that money would be halved. This means your personal financial plan, however solid it initially seemed, could be completely shattered, making the goal of a prosperous and comfortable old age seem distant. Many people nearing or in retirement often don't fully account for the long-term impact of inflation. They might focus too much on the nominal balance in their bank account or feel that the annual price increase isn't particularly significant. However, the power of compound interest, which Warren Buffett frequently mentions in investing, also has a negative twin when it comes to inflation: compound erosion. Each year, prices rise a bit, and the following year, the new increase is calculated on an already higher base. Over many years, the cumulative effect becomes enormous. Warren Buffett's investment philosophy offers a valuable implicit warning here. He always emphasizes the importance of investing in businesses with economic moats, sustainable competitive advantages that allow them to raise prices for their products and services in line with or even ahead of inflation without losing customers. Similarly, your retirement assets need such a moat to guard against the erosion caused by inflation. Warren Buffett is also known for disliking holding too much cash for long periods because he understands that cash doesn't generate returns, and worse, it loses value over time due to inflation. He once likened holding cash in an inflationary environment to watching your money melt away. Therefore, keeping a large portion of your retirement assets in cash or very low-interest fixed income instruments is a mistake that can destroy the wealth you've diligently built. The consequences of underestimating inflation in retirement are very real and painful. You might find yourself cutting back on essential expenses, reducing the quality of your food, limiting enjoyable recreational activities, postponing visits to children and grandchildren, or even struggling to pay ever-increasing medical bills, a factor also heavily influenced by inflation. Retirement, which should be a time of enjoyment and relaxation, can instead become a constant battle against rising prices, causing unnecessary stress and anxiety. The plan for a wealthy, comfortable life is at risk of collapsing. The solution to protect and grow your assets in retirement is to invest wisely, seeking real returns after inflation without taking on excessive risk. This includes investing in stocks of strong companies, following Warren Buffett's philosophy, to help combat long-term inflation and generate passive income from dividends. Another option is Treasury inflation-protected securities, TIPS. U.S. government bonds whose principal value and interest payments adjust with the Consumer Price Index, CPI, helping to protect investors. Real estate is also a potential avenue, with property values and rental income often increase with inflation, though it requires management and is less liquid. Finally, diversified investment funds like mutual funds or ETFs, which invest in various asset classes, help spread risk and have the potential to deliver returns that outpace inflation. Never let the silent enemy of inflation sabotage the retirement years you deserve. Proactively creating a financial plan and implementing smart investment strategies to protect the purchasing power of your money is crucial. Remember, the goal isn't just to have money, but to maintain the wealth and purchasing power of that money to ensure a comfortable and free life, regardless of how the economic landscape shifts in 2025 and the years to follow. Underestimating the long haul, the risk of outliving your savings. Medical advancements and improved living conditions have brought a wonderful gift, an increasing human lifespan. This is good news, opening up opportunities to enjoy a longer retirement. However, this positive aspect comes with a significant financial challenge, the risk of outliving the money you've prepared. Underestimating the long haul of your life is a serious mistake that can turn golden years into a period of anxiety due to depleted resources. Many people, when creating personal financial plans for retirement, often rely solely on average life expectancy or personal expectations, forgetting that living an extra 5, 10, or even 20 years beyond projections is entirely possible, especially as science continually advances, promising new breakthroughs even in the coming years like 2025 and beyond. Warren Buffett's investment philosophy can offer profound insight into this issue. He is renowned for his long-term vision, having famously said, "Our favorite holding period is forever." If a brilliant investor like Warren Buffett thinks in terms of perpetuity for his investments, then financial planning for retirement, a period when you no longer generate active income and rely entirely on accumulated savings, also requires a similar perspective, a preparation for a journey that could last much longer than initially calculated. Failing to prepare for a retirement that could span 25, 30 years, or even longer, especially for couples where one partner may live exceptionally long, is a critical oversight. Planning for only 15, 20 years after stopping work can be a risky gamble with your own wealth and security. The consequences of underestimating longevity are something no one desires. As savings dwindle while life continues, many are forced to face the prospect of financial dependence on children or relatives, creating a burden and potentially eroding personal dignity. The quality of life in one's later years can severely decline, from having to cut essential medical expenses and forego personal hobbies to living in constrained, deprived conditions. Instead of enjoying comfort and freedom, these years become fraught with constant financial anxiety. The goal of a prosperous and peaceful retirement becomes elusive. There are several important solutions to consider to address the risk of outliving your savings and protect your wealth. Firstly, plan your finances for a lifespan longer than the current average. Experts often advise planning for at least age 90 or 95, or even higher if your family has a history of longevity.
Secondly, research and consider financial products designed to provide lifelong income, such as annuities. Although annuities can be complex and require careful consideration, they can offer a guaranteed income stream, providing greater peace of mind about never running out of money. Lastly, even in retirement, maintaining a growth-oriented portion in your investment portfolio is crucial. Relying entirely on overly safe, low-yield assets may not be enough to offset inflation and maintain purchasing power over an extended period. A balanced investment strategy that continues to generate returns will help your retirement fund be more sustainable for this long haul.
Mistake 3. Putting eggs in the wrong basket. Unwise asset allocation and emotional investing. As you enter retirement, how you allocate your accumulated wealth and your investment approach become more critical than ever for protecting and growing your prosperity. The third mistake, often likened to putting eggs in the wrong basket, is unwise asset allocation and allowing emotions to dictate investment decisions. This can lead to severe consequences for your personal financial plan, especially when you no longer have a stable income from work and need these funds to cover living expenses, particularly in a potentially volatile economic climate like that forecasted for 2025. One dangerous extreme is becoming too conservative in managing your money. Fearing the risk of loss, many people approaching or in retirement tend to keep the majority of their assets in cash or very low-interest savings accounts. While safety might seem assured, this approach overlooks the enemy of inflation we've already discussed. Non-interest-bearing cash will slowly see its purchasing power erode, causing your wealth to diminish over time. Conversely, another equally risky extreme is becoming too adventurous. Driven by the desire for quick profits, perhaps to make up for lost time or to fund a more lavish retirement, some individuals pour money into high-risk investments or temporary fads they don't fully understand. When the market turns unfavorable, they can lose a significant portion or even all of their retirement savings. Beyond improper asset allocation, emotional investing is another pitfall many fall into when managing their finances. Financial markets always experience ups and downs. Panic selling when the market is down, selling at the bottom, or euphoric buying when the market is at its peak, buying at the top, due to fear of missing out, FOMO, are common emotional reactions. These decisions contradict value investing principles and often lead to losses, impacting long-term personal financial plans. Warren Buffett has offered invaluable advice on this matter. His famous principle, rule number 1, never lose money, rule number 2, never forget rule number 1, underscores the paramount importance of risk management, especially when you're at a stage where you don't have much time to recover from significant financial losses. Warren Buffett also advises investing in what you understand, in companies with solid fundamentals and long-term value, rather than chasing tips or short-term speculative trends. His saying, "Be fearful when others are greedy, and greedy when others are fearful," encourages a contrarian approach based on rational analysis rather than being swept away by herd mentality when making investment decisions.
The consequence of flawed asset allocation and emotional investing is that your assets not only fail to grow sufficiently to meet your retirement needs, but also risk severe decline. This directly threatens your financial security and the quality of life you expect, making the goal of a wealthy retirement more challenging. The solution lies in building a diversified investment portfolio that balances growth and safety objectives appropriate for your age, risk tolerance, and retirement timeline. When you have many years ahead, you can afford to take on more risk for potentially better returns. However, as you approach or enter retirement, capital preservation becomes more critical. Regularly review and rebalance your investment portfolio, perhaps annually or when significant life changes occur, but avoid making constant changes based on short-term market fluctuations. If you feel uncertain, don't hesitate to seek advice from reputable personal financial advisors. They can help you develop a suitable asset allocation strategy and keep your investment plan on track, guiding you towards a truly wealthy and secure retirement. Draining your lifeline, an excessive withdrawal rate and uncontrolled spending.
After years of hard work and accumulating money for retirement, one of the most crucial decisions you'll face is determining how much you can withdraw annually for expenses without depleting your funds too soon. The fourth mistake, which we can call draining your lifeline, is establishing an excessively high withdrawal rate and losing control over spending. This is a dangerous personal finance trap that can quickly erode the wealth you've painstakingly built, pushing you into difficult circumstances as you age and your health potentially declines, especially when economic factors like those in 2025 might bring instability. Many people, upon entering retirement, tend to want to enjoy life to the fullest. They may have more free time, more travel plans, and many desires to do things they've long postponed. This is completely understandable, but without a sensible spending plan and a sustainable withdrawal rate, retirement funds can be depleted at an alarming pace. Withdrawing too large a percentage from your investment accounts, for example 7 to 8% annually or more, especially in the early years of retirement, may not leave enough principal to continue growing and combat inflation or negative market fluctuations. When you withdraw more cash than your portfolio can sustainably generate, you are effectively eating into your principal, weakening your financial foundation for the future. Warren Buffett's life and investment philosophy implicitly contain a warning here. Despite possessing immense wealth, Warren Buffett is known for his relatively simple and frugal lifestyle. He doesn't flaunt his wealth through unnecessary extravagances. Instead, he values saving and letting money continue to work through reinvestment. Prudent spending, even when you can afford it, is a principle that helps assets remain sustainable and have the opportunity to grow over time. Excessive, uncontrolled spending, especially on non-essential items, will diminish your ability to maintain a wealthy and financially independent retirement in the long run. The consequences of draining your retirement fund are very clear. You risk running out of money before you pass away. This could force you to return to work at an older age, depend on your children for help, or face a life of deprivation, cutting back on basic needs. The plan for a wealthy retirement where you can pursue passions and enjoy time with family will vanish into thin air. Instead, there will be constant financial stress and anxiety, the complete opposite of what you expect at this stage of life. So, how can you avoid this mistake? The most important thing is to determine a safe and sustainable withdrawal rate. The 4% rule is often mentioned as a starting point. Withdraw 4% of your total retirement assets in the first year, then adjust this amount for inflation each year. However, this rule is not a rigid formula and needs to be adjusted based on your specific personal financial situation, expected lifespan, investment asset allocation, and market conditions. Consulting a financial advisor can be very helpful in determining the most suitable withdrawal rate for you. Additionally, creating a detailed spending plan and adhering to it is crucial. Clearly distinguish between needs and wants, prioritize essential expenses like housing, healthcare, and food, and cut back on non-essential or deferrable costs. Controlling spending doesn't mean you have to live miserably. It means spending intelligently to ensure your wealth and financial security last throughout your retirement years. The consequences of draining your retirement fund are very clear. You risk running out of money before you pass away. This could force you to return to work at an older age, depend on your children for help, or face a life of deprivation, cutting back on basic needs. The plan for a wealthy retirement where you can pursue passions and enjoy time with family will vanish into thin air. Instead, there will be constant financial stress and anxiety, the complete opposite of what you expect at this stage of life. So, how can you avoid this mistake? The most important thing is to determine a safe and sustainable withdrawal rate. The 4% rule is often mentioned as a starting point. Withdraw 4% of your total retirement assets in the first year, then adjust this amount for inflation each year. However, this rule is not a rigid formula and needs to be adjusted based on your specific personal financial situation, expected lifespan, investment asset allocation, and market conditions. Consulting a financial advisor can be very helpful in determining the most suitable withdrawal rate for you. Additionally, creating a detailed spending budget and adhering to it is crucial. Clearly distinguish between needs and wants, prioritize essential expenses like housing, healthcare, and food, and cut back on non-essential or deferrable costs. Controlling spending doesn't mean you have to live miserably. It means spending intelligently to ensure your wealth and financial security last throughout your retirement years. Mistake 5. Ignoring the time bomb, costly healthcare expenses. In the grand picture of a secure and prosperous retirement plan, there's an element often underestimated or even ignored, yet it harbors a devastating financial risk: healthcare costs. Imagine this as a time bomb silently ticking down within your personal financial plan. As age advances, the need for medical care typically increases, and in the United States, the costs for these services, especially long-term care, can become a colossal burden, consuming a significant portion or even all of your savings. Many people enter retirement without adequate preparation for this potential expense, believing Medicare will cover everything or simply not anticipating the true scale of the problem. Although Warren Buffett doesn't frequently comment directly on personal healthcare costs, his investment and risk management philosophy offers a profound warning. Warren Buffett always emphasizes the importance of thoroughly understanding potential risks and preparing for foreseeable adverse situations before making any investment decision. Similarly, smart financial management in retirement requires you to identify and plan for time bombs like medical expenses. Protecting your wealth and what you've painstakingly built throughout your working life is paramount. Ignoring a large and almost certain expense like healthcare goes against prudent financial management principles, undermining the foundation for a wealthy and secure retirement, especially as we look towards years like 2025 with potential changes in health policy. The consequences of not preparing for medical expenses are extremely serious. Cash and investment assets earmarked for retirement can evaporate quickly to pay hospital bills, medications, or costs for home care or nursing home services, where Medicare often covers only a very limited portion of long-term care. This not only shatters the dream of a prosperous retirement, but can also push you into debt, force you to sell valuable assets, or worse, make you dependent on your children, affecting your quality of life and independence. Financial stress will cast a dark shadow over the years that should be enjoyed in peace. So, what's the solution to defuse this time bomb? First, proactively estimate potential healthcare costs in retirement and incorporate them into your overall financial plan. Online tools and financial advisors can help you arrive at reasonable estimates based on your current health status and family history. Second, thoroughly research your health insurance options. Medicare, Parts A, B, and D, is the foundation, but you may need supplemental policies like Medigap to cover what Medicare misses. More importantly, seriously consider long-term care insurance. While the premiums may not be insignificant, it can be a wise investment to protect your assets from expensive long-term care costs. Finally, try to maintain a separate medical emergency fund, perhaps a health savings account if you qualify before retirement, or a dedicated portion of cash for unexpected medical expenses. Confronting and planning for healthcare costs is an essential step to ensure your wealth and financial security are not shaken during the golden years of your life. To build a prosperous and secure retirement future, identifying and avoiding the 5 major mistakes, from underestimating inflation and misjudging longevity to emotional investing, excessive spending, and ignoring healthcare costs, is paramount. Proactively create your personal financial plan today, regularly review it, and learn from the discipline, patience, and long-term vision of successful investors like Warren Buffett. Wealth and comfort in old age are not a matter of luck, but the result of thorough preparation and wise financial decisions, helping you protect your money and remain steadfast against life's uncertainties.